Welcome to section 8.2, institutional finance. So in this section, we're going to go over the role that international financial institutions like the IMF and the World Bank play, and then we will consider microfinance. So let's go ahead and jump over to the Canvas notes. And so the traditional means for developing countries to acquire finance outside of just regular financial markets has generally been through international financial institutions like the IMF, the World Bank. The IMF has traditionally sort of acted as a lender of last resort for countries on the verge or in the middle of a financial crisis. And the World Bank, though it started off basically making large infrastructure loans, really since the late 80s has also taken on a pretty big role in terms of providing finance to developing countries. So let's start off and take a look at the IMF. So the IMF came out of what was known as the Bretton Woods Conference in 1944. It began its operations December 1945 with 29 countries. The membership is up to 189 countries today. The initial role of the IMF was to stabilize exchange rates. So there was a period of time between 1944, 45, let's say, and 1971 in which most of the world's countries operated on a system of fixed exchange rates. It was a quasi-gold standard in that the US guaranteed the price of gold at $35 an ounce, and every other country basically would establish a fixed exchange rate to this gold price. So there was a burden, sort of on the U.S. to make sure that gold stayed at $35 an ounce. If the price of gold was starting to go up, they would basically sell it off. If it was starting to go down, they would buy it up. And basically there was a global system of fixed exchange rates. Now, that didn't mean that countries didn't devalue and revalue their currencies, change the value of that fixed exchange rate. But the role of the IMF during this period was to help countries out so that there wasn't a ton of movements in their exchange rates. In 1971, basically, the U.S. found that it was increasingly difficult to maintain the price of gold at $35 an ounce. The price was rising, and the U.S. was forced to keep on basically selling off its gold reserves. And they decided to drop the guarantee of gold at $35 an ounce. 2 years later, pretty much the global system of fixed exchange rates collapsed. You still have some countries, well, actually a decent number of countries that have fixed exchange rates, but most of the developed countries in the world operate with flexible exchange rates. Anyways, bit of an aside. So the way that the IMF works is basically like a big credit union. So countries pay a quota to the IMF, and that quota is based off of their economic size, how open they are, how important their currency is in world trade. And so the more that you put in, basically, the more control over decision-making at the IMF that you have. And so basically countries can borrow up to 200% of their quota annually, and over a fixed amount of time, they can borrow up to 600% of that quota. A lot of times countries in the middle of a financial crisis need to borrow more than this. So for example, when Greece got into this really bad debt crisis, Greece's quota was simply not enough. Even 600% of their quota wasn't enough to really bail them out. So the IMF basically coordinated. They would give some of the loans to Greece. They also got, countries in the Euro area involved to help out with the bailout too. But essentially they acted not just as a lender of last resort, but also sort of as the sort of central coordinating authority to help these countries out. So with the end of the Bretton Woods era in 1971, the IMF's role shifts. So before they were mostly, lending countries money in order to help them maintain their fixed exchange rate. So if a country was, having downward pressure on their currency, the IMF would basically lend them foreign currency to buy up their own currency to keep it up. If there was upward pressure on the currency, the IMF would basically, essentially, buy up the domestic currency that those countries were selling. And so in 1971, basically the fixed exchange rate system collapses, and then the role of the IMF changes. So they're no longer, principally involved in maintaining currency stability, and rather they start to become really much more involved as a lender of last resort to countries in the midst of a financial crisis. Now, the people of the IMF wanted to make sure that there wasn't moral hazard. So you remember moral hazard from the last section is that if a country knows it's going to get bailed out, it might actually take more risks. Simply knowing that, if the gamble pays off, they get to keep everything. If it doesn't, then the IMF is going to step in and pick up the tab. So as a result of this, the IMF, in a desire not to throw what we call good money after bad money, if a country's in the middle of a debt crisis, why would you lend them money if they don't change anything? They're just going to get into a debt crisis again. And so with that in mind, the IMF started imposing loan conditionality. So when the IMF lends a country money, it's part of something called a structural adjustment program. So this structural adjustment program basically lays out the terms of how much the IMF is going to lend, and basically they make loans in installments, so you get some money right away, but then to get additional installments, you have to meet certain conditions that are in the structural adjustment program. And the conditions are generally what we refer to as neoliberal economic reforms. You got to cut your government budget deficit. You need to basically increase the amount of your exports. If there's huge state-owned corporations, you need to privatize them. All sorts of things that can be theoretically justified as helping a country to pay off its debts. And so if the government's not borrowing as much, if the country's exporting more, they're bringing in more foreign currency. If they are privatizing, then this is something that maybe could potentially be a more efficient way to use that country's resources. And so the idea here is that, basically the IMF becomes really heavily involved in constructing economic policy for countries that it operates in. And this really expanded following the early 1990s. So in the early 1990s, you had the breakup of the Soviet Union. You had a lot of former Soviet states, a lot of countries in Eastern Europe that were former communist countries that were struggling with the transition to sort of free market capitalism. So the IMF had a lot of expertise. They had a lot of capital. And so they worked with these countries. And at least initially, it seemed like they were actually pretty successful. So buoyed by that success, a lot of the policymakers at the IMF decided they were going to get more directly, actively involved in crafting policy for the countries that they were operating in. Now, this policy of loan conditionality is pretty controversial. Now, you can certainly justify it in the sense that you want to reduce moral hazard. So you're not just going to give money to a country that got into trouble without demanding that they make some of the changes that they need to make so they don't get into another financial crisis. However, there is a problem in the sense that we assume that the kinds of conditions the IMF imposes are addressing the reason why that country got into a financial crisis. But a lot of the times, it doesn't seem like that's necessarily the case. In fact, the IMF basically imposes the same set of conditions for every single country. Reduce your budget deficits, increase your exports, privatize state-owned industries. And so in some cases, yeah, that's why a country got into trouble, is they had huge budget deficits. They have bloated state-owned firms and all this kind of stuff. And so maybe that is the right thing to do. But other countries, that's not actually the problem. In other countries, for example, if we take a look at the Asian financial crisis in 1997, the reason why those countries got into trouble is the IMF pushed those countries to open up their capital markets to international financial flows too soon. Too soon meaning that they didn't have good financial infrastructure in place. There was bad information coming out of countries like Thailand, Indonesia, and South Korea. And investors thought that they were getting much higher returns than they actually were. When people actually found out that much of the high returns in a lot of these countries is really a house of cards, they started pulling their money out really quick. Now, these countries were not running huge budget deficits. They were actually running big trade surpluses too. And so the IMF's recommendation of cutting budget deficits, of increasing exports, didn't really address the reason why those countries got into trouble in the first place. The reason those countries got into trouble is they opened up too quickly. And so this creates a situation where, the IMF has sometimes been criticized as not really worrying about the long-run health of these countries, but making sure that people get paid back. So the idea here is, if a country's in a debt crisis, then sure, having that country start running a budget surplus instead of a budget deficit is going to increase the chance that that government's going to be able to pay off its debts. But when you think about how does a government reduce its budget deficit, there's two ways to do it. You raise taxes and you cut spending. So raising taxes obviously is going to have a negative impact on the economy in the short run, but also cutting spending. Let's think about how that works. If you're a government in a developing country, oftentimes you're in power on the basis of some sort of form of clientelism, meaning that maybe you're in power on the back of what I refer to as an authoritarian bargain. Basically, there's not a lot of open democracy in that country. There's an authoritarian regime that's in power, and the way that they're in power is basically by offering people some kind of populist programs, whether it's subsidized food, subsidized electricity, free healthcare, free education, whatever it is, right? And so a lot of the times what happens is that these governments, when they have to cut programs, they're going to pick the kind of social welfare programs that they... Oh, sorry for the delay there. Going back to what we were talking about, we're talking about loan conditionality and sort of why it's controversial. And so again, we're saying that when governments are trying to reduce their budget deficits, oftentimes they are going to cut the kinds of programs that have the lowest political cost to them. And so that most often ends up being, cutting education programs, cutting health programs, cutting social assistance to the poorest people in the country, simply because the poorest people in the country have really the least political influence. And so oftentimes when the IMF goes to a country and says, hey, you got to cut your budget deficits, the end result of that is actually that they're imposing pretty significant costs on people that oftentimes had nothing to do with why that country got into a debt crisis in the first place. Okay, so let's take a look at, here are what, and did sort of a Google search of criticisms of the IMF, and here are some quotes that I've pulled off, from various people criticizing the IMF. So the IMF is run by the richest countries and for the richest countries. The IMF forces countries to cut social programs. The IMF caused interest rates in poor countries to go up so that investors could have a place to park their cash. IMF forces poor countries to eliminate regulations on foreign ownership so that multinationals can exploit local labor market conditions and low standards. By promoting free trade, the IMF is hurting domestic business owners in poor countries. Because the IMF forced the government to cut subsidies for things like bread and petroleum, poverty has gotten worse. The IMF's fondness for hard currency makes them push poor countries into producing goods for export. When all poor countries export, the price of exports falls, hurting poor exporters. The best land is used for export crops, leaving only poor land for food crops. So, each of these criticisms has some merit and some flaws as well. Let's take a look at the first one. Is the IMF run by the richest countries and for the richest countries? So the first part of that statement is 100% true. The IMF is definitely run by the world's richest countries. So this table shows quotas at the IMF. Basically, we have the top 6 countries here in terms of their quotas, and then voting at the IMF is proportional to how much your quota is. So the US by itself has 17.5% of all votes at the IMF. Now that's significant because if you want to change anything in the IMF's bylaws, basically the ruling document that says how they operate, you need an 85% supermajority, which means the US by itself can veto any changes to the IMF's bylaws. If we take a look here, OECD countries, which are almost all developed countries, so 35 countries representing 17% of the world's population, hold 65% of the votes of the IMF. Non-OECD countries, 83% of the world's population, only have 35% of votes of the IMF. So clearly, there is not sort of proportional representation at the IMF based on population. So the people that are in countries where the IMF is dealing with oftentimes have very little voice at the IMF. So definitely it's being run by the world's richest countries. Now, is it being run for the world's richest countries? Now, this is a bit more controversial. The sort of idea behind this is if you look at the kind of conditions that the IMF imposes, they are certainly to make sure that countries are able to pay back their debts. Now, who does this benefit? And it might not necessarily be the countries that the IMF is interceding in. Certainly it prevents them from being in a debt crisis, but oftentimes the conditions that are being imposed have enormous short-run pain, and especially if the kinds of programs that are being cut in order to reduce budget deficits are things like health and education, then that might limit long-run development in those countries too. Now, who does that benefit? The ability of countries to pay back their debts, it benefits the people that those countries owe money to because now they're going to pay back their debts. And predominantly those who are lending to these developing countries are rich country investors. And so that is where sort of this argument that the IMF is being run for the world's richest countries comes about as well. The counter argument to that is simply that, well, what do you want the IMF to do? They have to impose conditions. Otherwise, there's going to be moral hazard. You're just going to be giving money to a country that got into a debt crisis without making any changes. They're just going to get into another debt crisis. And so you can see there's two sides to this argument. All right, let's take a look at some of these other ones. The IMF forces countries to cut social programs. They don't actually force countries to cut social programs. What they're saying is you need to cut your budget deficit. Now, knowing how a lot of these countries operate, it's oftentimes social programs that are first on the chopping block when countries have to cut their deficits. And so, no, the IMF is not going to these countries and say, hey, cut welfare payments to the poor. But implicitly, they know that if they tell these countries you got to reduce your budget deficit, then they should know that one of the first things that these countries are going to cut are things like welfare assistance, unemployment insurance, health benefits, things like that are affecting basically the people that have very little political influence. The IMF definitely induces countries to raise their interest rates. Raising interest rates is one way to attract foreign investment. But of course, the problem with that is that if you raise interest rates, then anybody who wants to borrow to buy a house, anybody who wants to borrow to go to school is going to face higher borrowing costs as a result. A lot of times you do see countries based off of IMF recommendations opening up their capital markets. And oftentimes they're trying to attract more foreign direct investment. We talked about FDI having a lot of potential benefits. But of course, if countries are competing for FDI by cutting regulations, by offering tax breaks, this can end up doing more harm than good. Promoting free trade is the IMF hurting domestic business owners? Maybe. The argument is that trade basically can lead to greater efficiency, but the process by which it leads to greater efficiency is by reorganizing production in a country towards what it has a comparative advantage in. And that suggests that there's going to be some things that other countries do better than the country we're looking at, which means that if you're producing a good in an industry that that country is going to import when it opens up to trade, then obviously you're going to hurt. Now, eventually, resources will shift to what that country will export, but that is not a seamless process. That's a painful transition when some industries shrink. It's not like everybody who's in that formal, the industry that now competes with imports is going to be immediately able to shift over to the industry that now exports. The IMF, again, doesn't force governments to cut subsidies, but oftentimes this is what happens when governments are told by the IMF to reduce their budget deficits. And then let's take a look at the last one, the fondness for hard currency. Basically, the idea here is the IMF recognizes that if a country has a lot of foreign currency debt, then they need foreign currency to pay off that debt, because otherwise it's just going to take a larger amount of domestic currency to pay off their foreign currency debt when that country is in a financial crisis and their domestic currency is depreciating, going down in value. But of course, the only way that you get more foreign currency is exporting more. And export more, you are basically, again, reorganizing production. And some people are going to be hurt by that reorganization. In the long run, the country's better off. You're shifting production towards more efficient industries, but not everybody is going to be able to transition into those export industries. Okay, so let's take a look at the World Bank. The World Bank, created at the same Bretton Woods conference as the IMF, started off basically making loans to developing countries for large infrastructure projects, such as transportation networks, power generation, things like that. In the 1980s, the World Bank's focus shifted away from these big, sort of infrastructure projects towards providing funding to developing countries that are having a hard time meeting their debt obligations. So basically, they were like the IMF, but they were lending almost exclusively to poor developing countries. They had the same kind of process of loan conditionality, were requiring countries to make the same kind of neoliberal economic reforms. And this led to a lot of criticisms. In the 1980s, the organization UNICEF, basically made the argument that the structural adjustment programs of the World Bank had been responsible for reducing the health and education of millions of children in developing countries. Now, the World Bank has made some reforms, certainly more than the IMF has. And so they're making greater efforts that the kind of conditions they impose in their SAPs do take into account the most vulnerable people, receiving loans. So they're basically saying, hey, cut your budget deficit, but preserve, programs that are working on increasing health and education in these countries. They also tend to be a little bit less of a one-size-fits-all kind of policy like the IMF is, and they tailor their programs to really targeting the specific needs within the countries they operate in. But the World Bank is still subject to criticism. Vote shares in the World Bank are not based off of population, but rather based off of the country income. So if we take a look at the countries with the 10 largest vote shares that should say the World Bank, not the IMF, only 2, China and India, are classified as developing. Now, they've been adjusted a little bit to give developing countries more say, but still, the majority of the votes are in the richest countries in the world. And since the majority of the population are in developing countries, we still have a disconnect between, the people that the World Bank is affecting with its policies and the voice that those people have at the World Bank. And then finally, and this is a segue into the next thing that we'll talk about, is a lot of people criticize the World Bank for its very top-down approach. So the idea here is that you've got economists at the World Bank, and they, basically each economist has, they have a country that they work on. So they're at like the Brazil desk or the Burkina Faso desk or whatever it is. And then, they have, sort of their bosses have a whole region and so on and so forth. Basically, they are country experts. Right? They don't live in those countries, but, they research them. They collect data on them. They are the ones that know, I guess, what are the big structural problems in those countries. And so those economists are basically coming up with policies, and they're saying, hey, this is a problem. Let's work on this, right? So maybe they identified there's a bad transportation network, so they're going to try to build infrastructure. Maybe they identified that, there's a low level of education, and so they try to build more schools, okay? So a problem with this is that with this kind of top-down approach, right, the World Bank says, hey, we're going to give you money to fix this problem. Do they just give it to the government? Well, governments in a lot of these countries are not the most efficient. They're oftentimes very self-interested and not really accountable to the people. And so there's nothing that says that the government's not going to swallow up a lot of that money. You can work through intermediaries, but of course, a lot of this stuff ends up getting swallowed by overhead, right? So for every dollar that, the World Bank has given to a country, maybe 25 cents actually ends up in the hands of the people that it was intended to help. Another problem with this kind of top-down approach, though, is that who knows better what a country needs? An economist based in Washington, D.C., who is studying this country, but didn't grow up there, doesn't know it, hasn't lived there, or the actual people that live in that country, right? And so the actual people that live in that country probably have a better idea of what needs to be changed, right? They may not have the resources to change it. They may not have the political freedom to change it. They may not have the skill needed to effectively implement those changes, but they have a pretty good idea of what the problem is. And so rather than have this sort of top-down approach where you have, an economist in Washington basically dictating, hey, you need to do this, this, and this, why not actually work directly with the people on the ground who can tell you, hey, we need to do this, and this is what we need to accomplish our goals. Okay. And so this kind of grassroots bottom-up form of development financing is really behind the notion of what we call microfinance. So microfinance basically starts with the notion that there's a lot of poor people in developing countries. Sorry, my dog is trying to catch a fly by the window. Anyways, there's a lot of poor people in developing countries that are completely shut out of credit markets. So they don't really have a lot of collateral. Oftentimes banks in developing countries are really underdeveloped. There's maybe a couple of banks and they really only make loans to large state-connected businesses. And so a lot of poor people that, they don't need to borrow much. Maybe they need to borrow $100, $500, small amount of money. They would never be able to obtain financing from a traditional bank. So a traditional bank would rather make, for example, a single $10,000 loan than $1,000 loans, right? So the monitoring costs are lower, the servicing costs are lower, and so it just doesn't make sense for a bank to lend people $100 at a time, right? The costs are just going to be, out of the question. And so a lot of poor people that don't need to borrow huge amounts of money, small amounts of money, they don't really have any collateral, were being shut out of credit markets, and this really, limited the growth of a country because a lot of that economic potential in that country was unable to sort of develop because they couldn't obtain financing for their ideas. So in response to the borrowing needs of poor people in developing countries, microfinance really began with Grameen Bank, which is a nonprofit founded by a guy named Muhammad Yunus, who won the Nobel Peace Prize a few years back. And they started by making small loans exclusively to women in Bangladesh in 1976. What they found was that by lending to women, women tended to have higher repayment rates than men. And certainly, as we've discussed a couple of times, by increasing female income and empowering women, this had a multiplier effect, because more of that money ended up being reinvested in household education and health. As microcredit started to expand, another sort of common feature became what's known as group lending. So group lending is when you have members of a borrowing group, right? And people have individual loans that they borrow. So an individual will borrow money from the microfinance institution, but if anybody who's in that group is behind on their payments, then nobody can borrow. So the idea here is that it helps defray the monitoring costs from the microfinance institution and puts it on the borrowing group. Because let's say I want to borrow, but my buddy that's in my borrowing group is behind on their payments. I can't borrow until they get current on their payments. So I'm going to influence pressure on them. I may even help them out to make their payments just so I can obtain a loan as well. Okay, so microfinance has really been something that's gotten a lot of attention for a number of reasons. So first, obviously, it fills in a really important gap in the sense that there's a whole bunch of people that have been shut out of credit markets, and so microfinance creates an opportunity for them to gain access to these markets. Second, it's had remarkably high repayment rates and really low default rates. So, just rates that, traditional banks would dream about, 90, 95%, 97%. repayment rates, people paying back their loans on time. And keep in mind, these are the poorest people in the poorest countries borrowing small amounts of money, no collateral, no nothing like that. And despite all of this, they're paying back these loans at remarkably high rates. So with those two things, people look at it like, well, maybe this is a really good way to finance development. But we need to be a little bit careful. And the reason why we need to be careful is because right now, microfinance is pretty small, especially when we compare to the amount of money that's coming through the IMF and World Bank, and certainly the amount of money that's going through traditional financial markets. And so if we were to scale up microfinance to the size that countries really need to finance their development, there's a lot of questions about whether or not the benefits of microfinance would translate or are scalable. So, if we were to scale this up, what would happen to repayment rates? What would happen to default rates? They might rise. And the reason is that if we take a look at what's happened to microfinance, as it's grown, the number of microfinance institutions that are for-profit institutions has increased, right? And that only makes sense, right? There's nonprofits are never going to be able to provide all of the financing needs that developing countries have. And so for-profit institutions are going to be a natural part of a market developing. But of course, for-profit institutions are going to charge higher interest rates because that's how they make profit. And so if we take a look at microfinance interest rates by country, you can see the average interest rate is like 35%, which, in the US, that seems like a ridiculous interest rate to be borrowing at. It's not so high in a lot of developing countries, but still pretty high, right? And in fact, the countries where microfinance has been more established, there's a lot more of these nonprofits, they're a bit lower. But in places where there's a larger number of for-profit microfinance institutions, we have really high interest rates, 50% and above in some of these cases. Well, as you increase interest rates, people are more likely to default on their loans because they have to pay back more in interest. But of course, as repayment rates go down, as default rates go up, then the risk of lending goes up and interest rates are going to rise to compensate for that extra risk. As interest rates go up, default rates go up, and it's a vicious cycle that continues. Okay. Another issue or another criticism of microfinance is that it has a really strong focus on borrowing, not on savings. And so most microfinance is being funded from abroad. People in developing countries are borrowing. And so there's not a lot really of effort being spent to develop domestic savings. Rather, everything's on, hey, borrow this money, pay it back. Rather than, hey, you should save this money, and let's develop institutions that encourage savings. Another criticism is that even though we see really high repayment rates of microcredit, this might be a statistical artifact. And so the idea here, suppose that we have 100 loans that are made by a microfinance institution. And those 100 loans, 97 of them are made to a single person. And that single person paid back their loan every single time. 3 of the loans were made to 3 different people. And each of those 3 people basically defaulted on their loan and were never able to borrow again. So if we take a look, 97 of the 100 loans were repaid on time for a 97% repayment rate. Great. But only 25% of borrowers actually paid back their loans. That's a 75% of borrowers defaulted. And so basically, if microcredit repayment rates are being sort of influenced by essentially the same pool of borrowers that are cycling through the system, then this really does bring into question that if we scale up microcredit, we bring in a whole bunch of new borrowers. A lot of those new borrowers are not going to be the ones that have shown a track record of paying back, and so the repayment rates are going to go way down. All right, and then finally, especially in countries where there is a lot of gender inequality, even though loans are oftentimes given to women or made to women, oftentimes it's men that end up controlling the funds. And so basically you lose out on female empowerment, you lose out on increasing female income, but you are saddling women with all the debt and the credit risk. And so there are some very valid criticisms of microcredit. And when we think about, what's the best way to finance development, it can't just be microcredit. It's really unlikely we're going to be able to scale it up to the efficient scale. And so we're going to need to use things like microcredit, which is a great idea, grassroots up kind of form of development, but we still need traditional financial markets. We still need the role of international financial institutions like the IMF. All right, so that's stay tuned for some play pause questions, and then I will see you in the very last section of the semester, 8.3, on foreign aid and randomized control trials. Bye-bye.